Wall Street has a secret. Actually, it has many, but this one is worth billions. The trades you think are free aren't. The risks you think are disclosed aren't. The ratings you think you can trust, you can't. Today, we're going to expose how America's financial system makes billions off you in ways you're not supposed to notice. This is the billion-dollar scam Wall Street doesn't want you to know. From zero-commission apps like Robinhood, to hidden leverage bombs like Archegos, to the ratings agencies that rubber-stamped the financial crisis, Wall Street has perfected three machines that quietly siphon wealth. The scam is simple. Extract profits in the shadows, pay a fine when caught, and carry on. And the fines, they're nothing compared to the profits. Let's start with the scam hiding in plain sight. So-called free trading. Apps like Robinhood told you, we killed commissions. Trading is free. But here's the catch. You're the product. It's called Payment for Order Flow. PFOF. Every time you place a trade, your broker doesn't just send it to the exchange. They sell your order to a market maker like Citadel Securities who pays for the privilege of executing it. Why would they pay? Because if they can see your order before the market does, they can make money off the spread. Fractions of a cent on each trade, but scale that across billions of shares and it's billions of dollars. In December 2020, the SEC charged Robinhood for misleading customers about exactly this. They paid a $65 million fine.
Popular investment app Robinhood has enjoyed massive growth this year, as investors like you and me, aka retail investors, flooded the company's platform during unprecedented market volatility from the COVID-19 pandemic. In just the first 4 months of the year, Robinhood reported a record 3 million new users. The app pioneered commission-free trading, a practice that competitors like Charles Schwab and TD Ameritrade copied. But today, the SEC charged the company with deceiving its customers about how it makes money. It's the second legal action against Robinhood in 2 days.
In March 2025, FINRA nailed them again, this time for how they handled order routing. That's 2 major hits in just 5 years. And yet Robinhood isn't the exception. This is the business model, but what if your order never even sees the exchange? Enter the world of dark pools. Private exchanges where trades are hidden from public view. In 2016, Barclays and Credit Suisse were fined over $150 million for misleading clients about how their dark pools worked. The official reason? They told investors one thing while doing another. The real reason? Dark pools are insanely profitable. And when meme stocks like GameStop went nuclear in 2021, the SEC dug into the chaos. Their 45-page report explained why Robinhood and others restricted buying. Clearinghouse collateral requirements exploded. In plain English, the plumbing of Wall Street almost broke. This wasn't a conspiracy theory, it was the mechanics of a system designed to make money off your flow until the pipes burst. Now, let's move to something even scarier, risk that hides in plain sight. In 2021, a quiet family office called Archegos Capital detonated one of the biggest hidden bombs in Wall Street history. Here's how. They used exotic contracts called total return swaps. These swaps let Archegos borrow exposure to stocks from multiple banks.
Those sales, and if so, is that something that now changes? I mean, could you potentially see more communication or not?
Without publicly disclosing the size of their bets.
They were still willing to loan him massive amounts of money.
Each bank thought they were lending a little. In reality, Archegos had built massive, concentrated positions, tens of billions of dollars.
You're going to crystallize some pretty significant losses if you wait to sell. So this is a fantastic scoop from the Bloomberg banking team led by Stephen Arrows, saying that Deutsche Bank was able to do a big sale on Friday, so the same day we saw those block trades from Goldman of about $4 billion. We don't know everyone who they sold it to, but we do know hedge fund Marshall Wace, the behemoth in Europe, was one of the ones who bought here.
When those stocks dropped, Archegos couldn't meet the margin calls. The result? Over $10 billion in losses for global banks.
Various conversations with sources at Goldman Sachs and Morgan Stanley confirmed that while they had large exposure, $10 to $15 billion respectively,
Credit Suisse alone lost $5.5 billion.
Meanwhile, Deutsche Bank on the record told me, quote, "We have significantly de-risked our exposure without incurring any losses. We're managing down the immaterial remaining client positions on which we do not expect to incur any loss," end quote.
In July 2024, a jury convicted Archegos founder Bill Huang of fraud and market manipulation. In December 2024, he was sentenced to 18 years in prison.
Archegos Capital Management founder Bill Huang was just sentenced to 18 years for fraud and market manipulation that led to his firm's collapse in 2021.
Bill Huang faces 18 years in jail.
Yep, like you just said, he got 18 years. The sentence came down relatively quickly. Usually judges kind of take a little time to pronounce sentence. They read out all the different factors they have to consider and what weight they gave them and how they affected it. It was very succinct.
He had been convicted there in July on 10 charges, including wire fraud, securities fraud, and market manipulation.
He kind of just came out and said, you know, this is the most difficult thing I have to do. It's always a problem. I never like the sentence I'm giving out. Nobody's ever going to be happy with it.
The lesson: the system didn't catch him. The banks loved the profits until the crash. And this wasn't an accident. It was the system working as designed. Opacity equals profit until it doesn't. Now let's go back to the granddaddy of Wall Street scams. The Ratings Racket. Before the 2008 crash, ratings agencies like Moody's and S&P stamped billions of dollars of mortgage-backed securities with a golden AAA rating, the safest rating possible. The problem? Many of these securities were toxic. Subprime mortgages disguised as investment-grade bonds. When the bubble burst, the global financial system nearly collapsed, and the ratings agencies, they paid fines. S&P, $1.375 billion in 2015. Moody's, $864 million in 2017. Goldman Sachs, $550 million for its infamous Abacus deal in 2010. That's a lot of money until you realize the profits were far bigger. To them, fines weren't punishment. They were a line item. By 2017, banks worldwide had paid more than $321 billion in post-crisis fines. But the system didn't change. Because the scam isn't illegal, it's structural. So what's the scam? It's not one bad actor or one rogue firm. It's a machine. Your orders are sold to the highest bidder. Risks are hidden behind opaque contracts. Trust is outsourced to agencies that failed us once and could fail us again. Each cycle, billions made, billions lost, fines paid, and the game continues. And who ultimately pays? You, the retail trader, the pension fund, the taxpayer. The billion-dollar scam isn't a bug in Wall Street's system. It is the system This was the episode of Behind the Billions. If you want more corporate secrets, dark money scandals, and billion-dollar schemes exposed, hit subscribe, because what you don't know is already costing you. This video summarizes publicly reported cases and court fillings, sources only.